Good morning, everybody. Rob Barnes here with Integrated Insurance. Thank you for taking time to learn about long-term care, both concerns and solutions. Today's topics are going to be what are the risks of needing care? And if you need care, what will the cost be? We'll spend a little bit of time on those statistics. Most importantly, we hope to inspire you to further along your plan or start your plan. And so we hope to inspire some conversation and help you create your plan along with your advisors. And as usual, when we face large risks, maybe we want to transfer those risks. So we will be discussing the different flavors of long-term care coverages available in today's marketplace. And as usual, I'll share some perspective along the way. Now, today is filled with a lot of facts and figures, but I would be remiss if I didn't discuss the emotional side of the situation. And I think there's a great story that was on 60 Minutes. They followed a New York couple, Mike and Carol, from 2008 to 2018. You see, in 2008, Carol was diagnosed with Alzheimer's. Mike had to retire early to become her caregiver. One of the things that Carol loved to do was watch movies, but soon after her diagnosis, she lost the ability to concentrate enough to watch them. Her favorite movie star was Clark Gable. And by 2011, although she could still recognize the name, when asked who he is, she was unable to explain who Clark Gable was. And it was just a short 3 years later in 2014 that she couldn't even remember Mike's name. Mike was spending more than 9 hours a day caring for her. He considered it his duty and responsibility, and he wasn't sure he could afford to pay for her care otherwise. And unfortunately, in 2018, he had the heartbreaking decision to put her into a care facility because he was running himself ragged and wearing out his own health. He even had suicidal thoughts, as he admits in the interview. Dementia and Alzheimer are the scary parts of these things, and we all fear a long stay in a facility. But the reality is these statistics are scary. There's 5.7 million today diagnosed with Alzheimer's. There's 14 million expected over the next 30 years. And the average length of stay for this type of situation is anywhere from 4 to 8 years, and some have lasted beyond 20 years. And we know that 16% of the people caring for others these days are caring for them unpaid, i.e. family members, most likely, or close friends. And 1/3 of those caregivers are above age 65. And the reason I start with this is because I've seen it. I've watched two friends, parents, go through it. And I'm watching my dad right now go through it. Sorry, I always get choked up on that one. But my mom is in Mike's position today. She's at her wit's end, and it's not going to be long before we have to put dad somewhere. So although we'll get back to the logic and reason and stats and figures, I don't want to dismiss or to minimize the emotional impact that this can take on a family. And that's why we want you to have a plan and discuss these things with your family. So the most well-known statistic in the industry about claims is that once you reach age 65, you have a 70% shot of needing care. Obviously, then a 30% shot of not needing care at all. And if you follow the graph, the pie chart, excuse me, you can see that there's a 17% chance of needing care for a year or less. And so you have about a 50-50 shot of either needing care for 1 year or less or not at all, or needing care beyond 1 year. And it's these areas here, the 2 years and beyond, that scare us. And as we just discussed with the Alzheimer's, it's those long-term stays that can really do damage to somebody's portfolio and situation. So some other statistics from our friends at Mutual of Omaha. The average claim age is 79 years old. This isn't just the old person's claim. We have younger people. Often they might get into accidents or so, or have strokes at younger ages. And their youngest claimant right now is 27 years old. We know that women are the majority of claims, almost 70%. And the primary reasons people are needing care these days are dementia, heart disease, arthritis, and the list goes on. About half of the claim dollars for Mutual of Omaha are being used for cognitive issues these days. Some additional statistics for you: about 70% or more of claims start at home. And as people's health deteriorates along the way, assisted living and nursing home comes into play. And of course, $60,000 a year is the typical cost for home care around the clock. And a nursing home can run up to 95 grand a year for a semi-private room. Women need care almost twice as much as men, 3.7 years versus 2.2. And below, we have the cost of care both for today and down the road. And so if you're considering long-term care, that's great. And know that the costs obviously are only rising. I believe today's inflation rates are higher than before, but care has been running at a higher inflation rate than just 3% is what I want you to know. And so somebody who might need care today at the cost of $95,000 for a nursing home in 20 years, we expect that to be 170. And of course, if you need care for longer, you can see that 3 years of care, 20 years out, could be over $500,000. Now, I'm a big music fan. Those that hang around me will always hear me quoting song lyrics. I find wisdom in some of them. And today I share Todd Snyder, his song Statistician Blues, where he sings 65% of statistics are made up on the spot and 82.4% believe them, whether they're accurate statistics or not. But it's the refrain of his song that I think hits well here. It's too much to think about, too much to figure out. You're stuck between hope and doubt. And so today, we hope to give more insight and help you determine what it is you believe. Are you planning for probabilities, or are you planning for protection? Now, we're not in a classroom here in this Zoom world, so a show of hands won't work here, but everybody on the call today may know somebody who's currently caring for a parent, a spouse, or even a child. And you might know people who are spending down their estates for care because they didn't have enough resources and had a claim long enough to do devastation to their estate. And what I want to mention, although I share a lot of different statistics, and there's a lot of sources out there, don't confuse the long-term care statistics with other insurances, like auto and homeowners insurance, because the claim statistics are significantly higher. I think the odds are 1 in 1,000 that you're going to have a fire at home. And of course, you have a 1 in 10 chance of needing care for more than 5 years if you had Alzheimer's. And insurance, if I knew which one of you in the audience today were going to need care, it'd make sense to just insure you, but it doesn't work that way. And I want to emphasize that a lot of people kick the can down the road regarding this subject, and they're not sure what to do. And so they delay things, but it takes good health and money to buy long-term care insurance. And so, not everybody's going to buy insurance. It doesn't make sense for people, but others it may. And I don't underestimate the value of tax-free cash when needed. A lot of people confuse their pile of money with their income flow. And when you decumulate, when you have a stream of income, when you need money, there's usually a cost to that liquidity or cash flow. And so if you have a large qualified plan, an IRA, 401k, when you reach in to get $1, you're going to have to pull 20, 30 cents out to pay income tax as well, and that shrinkage. And same thing with the stock market. As of where we're at today in the market, we're down for the year. And if you pull $1 out, you're realizing losses. And if you keep doing that, you'll deteriorate a portfolio a lot quicker in down markets when you're pulling money out and realizing those, so to speak, paper losses. So what's your plan? If you need care, who's going to care for you? Are you relying on the government? Are you relying on yourself and your funds? Are you relying on family? Are you relying on the government? Or does it make sense to consider insurance as part of the plan? So we'll look at each one of these in a little bit more detail. If you self-fund, the concern is, will you have enough? And if you're going to self-fund, what account are you going to draw from? We've already mentioned the issue of pulling money out of qualified or pulling money out of stocks. If you're going to self-fund, depending on the level of your assets, you might want to consider having a reverse mortgage line of credit, which of course is a lot higher cost today than it was before, as things inflate here. But it just means that some people are going to have to use every dollar they have for their care situation. And some people have a lot of equity in their home that they might need to tap. And so if depending on your asset base, you might want to consider a reverse mortgage line of credit if you're going to self-insure. And if you have any legacy goals, of leaving something behind, and again, this is all determinable by the asset level that you have. If you have a goal to leave something to somebody, you might want to do it either through a direct gift now, so to speak, or a irrevocable trust where you put assets into it so that they're not part of your estate. And if you end up in a Medicaid spend down situation, you can still accomplish your legacy goals. Some people would use life insurance for legacies as well, but you don't want to own the policy if we have a concern that you might spend down your estate. As far as family, will your family be able to care for you? And what will it do what will you do if or when they can't? And most importantly, have you had a family discussion? I often talk to clients and they say, oh, we're okay, the kids are going to take care of us. And my first question is, do they know that? Have you really considered the consequences of what it does to them physically, financially, emotionally? I know that my wife and I had a discussion about my dad, and we agreed that it would put too much on our strain. We have a special needs child that we're already caring for, and we know that we need to put dad somewhere one way or the other. So how will it impact your kids' lifestyle? Geographically, are they available even? How's their health? Do they have a career and a work life? And what will it do to their financial resources or retirement funds if they have to take time away from work for caring for you? The government, a lot of people mistakenly think that Medicare pays for you. I'm going to share some information about some new government programs that are going on that really just, I think, add confusion and a false sense of security to people. And I'll address that near the end of today's presentation of what went on in the Washington State CARES Act that came into play last year. And a number of other states are looking to do this. But Medicaid is what pays for long-term care, but they only pay it after you've spent down most of your assets. And of course, if you know anything about a Medicaid available rooms and so forth, the quality of care is often diminished with them. And so I don't know what state you're living in, but in Illinois, they're going to allow my mom to keep $109,000 in assets, her house and her car, and they're going to take the rest along the way as she spends down. Now, they have some money to pay for dad for a while, but if he's in there for quite a while, my mom's going to end up being in a spend down situation here. It's just the reality. And some people aren't aware, but in the low right-hand corner, I have this filial law mentioned there. And these are some laws that are on the books of many states. About 25 to 30 states have filial laws, but they haven't really enacted upon them. It's my concern for my own situation and others, that they might start enacting filial law someday. And what this says is, if Medicaid paid for mom or dad to get care, at the end of the day, they can come to the kids and get that money back. Now, they haven't really enforced this, but there's some interesting case going on in Pennsylvania to look out for here. And again, as things, we're maybe broke as a country, certainly as the state of Illinois, something's going to have to give. They can't just make Medicaid pay for everybody. There isn't the resources for it. And so that leads us to, does insurance make sense for you? Because we want to leverage some of our assets and preserve the rest of them. We want to create tax-free benefits, and we want quality care when we need it. So just as we do with auto and home or life and health, we transfer the risk. And that's what we're going to get into now, is looking at the different flavors of long-term care insurance products in the marketplace. But long-term care is all about, in my opinion, it's about asset protection. It's about asset leverage. It's about protecting your family, providing dignity and peace of mind. So as we look at the risk transfer options, the insurance options, there's three flavors out there. One is pure protection. This is known as traditional long-term care insurance. The other is what I call payback and protection. These are the hybrids that are available today. And the third option I call a known outcome, which is a life insurance policy with a rider making the death benefit available dollar for dollar if you need care. And so let's dive into each one of these. I want to preface that my numbers might be shockingly high for you, but in order to fairly compare the benefits, we needed to equalize the premiums on the different options we're showing you. So we're about to show you a $10,000 a year premium for 10 years for both Jack and Jill. So think of it this way: Jack and Jill are going to, over the next 10 years, take $100,000 apiece out of their pile of money, and they're going to take that money and leverage it, hopefully to protect the rest of the assets. Pure protection, it is best understood to compare a traditional long-term care insurance policy to auto insurance. You're going to pay, and unless you have a claim, you don't get anything back. Now, you've likely heard some of the scary stories about long-term care insurance companies and pricing and everything, and most of those horror stories are related to traditional long-term care insurance. There's some whopping increases coming along the way with some carriers that didn't accurately price things. And, we understand, and I just want to emphasize and comfort you that today's pricing we think is much more realistic, and I'm not going to say you won't have an increase in price down the road, but you are likely not to experience what people have in the past, because we've learned and we've gotten better at the actual statistics. This whole industry of long-term care is only about 40 years old, unlike other parts of insurance that are hundreds of years old. So it does provide the largest amount of care for the lowest cost. It could have some potential asset protection value here in partnership states. But as mentioned, if there's no claim, there's no return to you, and you should expect some kind of rate increase down the road. Sans, there's one exception in the industry, that there is a carrier that can guarantee pricing for a shorter pay policy. But there's fewer options available in this arena. And if we look at the numbers, this is looking at Jack and Jill together. We have $20,000 a year we're going to outlay. Again, we're taking it out of our pocket on the left and putting it in our pocket on the right, and we're going to leverage it with this pool of care in case we need care down the road. And Jack and Jill is a 60-year-old couple, to be clear. We have a 4-year benefit period that we're designing with 3% inflation, and we have the shared care rider, which with this carrier is actually a third bucket. So the way to say that is Jack and Jill are going to start with having a $5,500 a month available for each one of them. Their combined pool of care respective per person is 264. And with that third pool, that means that immediately year one, when they pay the $20,000, they've leveraged their 20 into a pool of $750 plus $1,000. I'm rounding there to say that we have 3 buckets of 264, Jack, Jill, and that third bucket. And if we look at age 80, they would have now, they've completed their payments here over 10 years. They spent $200,000 in premiums, but they now have a care bucket just shy of $1.5 million. And each of them at age 80 could draw $9,900 per month as needed until the full bucket is gone. So this is what traditional looks like. And now we'll go to payback and protection. I'll just pause for a second for those who might have joined later. There is a Q&A box if you want to ask some questions, and we'll get to those when we're done with the presentation and share a few other things for you at the end. So payback and protection, what's known as hybrids in the industry. What they do is they kind of shore up the 2 weaknesses of traditional, whereas traditional, you pay, and if you don't have a claim, you get nothing back. Hybrids are going to pay back something, usually just your money, sometimes a little bit more than your money. We guarantee pricing with hybrids, so we have no price exposure risk later on, especially after we're retired. And so we know that a significant portion of the marketplace chooses hybrids or Life with Rider over the traditional product for these kind of reasons. And an additional benefit you can have with a hybrid is you can design it to be able to quit and get your money back after a period of time. So if you've allocated money here when you were early in retirement or before you even retired, and later in retirement things didn't work out as well, and you have more important things to worry about than your long-term care protection, you can quit and get your money back if we want to design things that way. And there are limited funding options in the hybrid space, and often most of the hybrids, there's exceptions to a lot of things in my world, but a lot of our options need to be paid either in a lump sum or over a 10 or 15 year period of time. So they don't let you pay over your lifetime with a few exceptions, of course. And it is going to take a higher premium. Think about it, all things equal, if we're guaranteeing pricing and we're guaranteeing you're going to get something back if you don't need care, you know, that's an added cost versus simply the risk portion of things in the traditional product. And so when we look at the Jack and Jill bucket here, we're going to look at Jill specifically. We're saying that she pays $10,000 a year for 10 years. After the 10th year, if she wanted to quit, she could get her whole $100,000 back. If she dies early on, the death benefit might be a little bit higher than 100, but it'll settle back down. And anywhere along the way, if she dies in her sleep, never needed care, she'll get $100,000. And to clearly state, if she needed a little bit of care and then she died, they'd pay back the $100,000 minus the part they paid for care. So she's guaranteed to get $100,000 back from this kind of a plan, whereas the traditional pays her back nothing if she doesn't use care. And the reason you buy this, of course, is the pool of care. So from day one, she'll start with a $3,000 monthly benefit, and by age 80, that'll be a $5,400 monthly amount available. And you can see the pool of care from day one is $230. And at age 80, it's over $400,000 as far as her pool of care. So this is how a hybrid would look with the same kind of pricing. And we'll look at a comparative chart in a second. The last option, and excuse me, I'm sorry, this is the page with showing Jack and Jill's bucket for hybrids here. So we bring Jack into the fold and show you that he would start with a little higher monthly benefit and a higher bucket of care. Again, think about the stats where I showed you 70% of women are needing care versus 30% of men. That's why women cost more. And so Jill's getting a little bit less benefit for the same premium dollar is something to note here. But down at age 80, whereas we looked at the traditional, And with that third bucket at age 80, they had over $1.5 million of total coverage, and they had monthly coverage almost 10,000. You can see it's a lower monthly, and they each have a combined about $1 million in benefit between the two of them, just to compare with the traditional option. Now we'll look at guaranteed life with a rider. Now, I want to preface, a lot of people, even advisors and agents that I work with, the world wants to lump this choice into the hybrid. So a lot of the world sees only traditional or hybrids. And the reason why guaranteed life with a rider stands on its own is that it's different from hybrid in this way. In a hybrid, I put my dollar in and I leverage it maybe threefold to start with. But in the guaranteed life with rider, my death benefit is my pool of care. So they're equal. And we know that we're going to pay out that death benefit one way or the other. It's a known payback where, we guarantee the most because it's going to pay that death benefit whether you needed care or not. And if you use half of it for care and then you pass, the other half will be paid as the remaining death benefit. There's a couple unique joint policies available in this arena, and I'll address one of them. And I want to emphasize the difference between projections and guarantees. You see that I use the lingo of guaranteed life with a rider. We do have all types of chassis of life insurance in the marketplace. But I think when we talk about this subject, one of the reasons people go to here is that they don't have the risk of a surprise price increase like a traditional policy has. And so we prefer, and most clients prefer, to have a guaranteed life insurance policy, not a quote unquote projected one. So what would Jack and Jill do if they both spend $10,000 a year for here? Well, Jack would buy $250,000 and Jill would buy a few dollars more, and they'd be able to access their death benefit at a clip of $10,000 per month, which would last for 25 months. So just a couple years of coverage here if they need it. And I tend to be a bottom line guy of what's the value proposition here. So note that guaranteed life with rider is going to pay this $254 and $267 one way or the other. And you have to go down the road to see what the value proposition is. But note, if Jack or Jill live to age 90 and die at age 90, the result of the premiums versus the death benefit is equivalent to a 4% net rate of return. In other words, if you were to put $10,000 a year for 10 years aside and you needed the money at age 90, you would have had to earn a 4% net rate of return. So think about that. You gross it up by a management fee, you gross it up by some kind of taxation. And so I would tell you that that might be a 6% gross. And again, this is a guaranteed contract with no risk. And so some people prefer to do this option because they know, hey, even if I don't need care, this goes to my family. I didn't hurt myself. I didn't throw money out the window, so to speak. And for whatever it's worth, this is what I own because I understand it and I have the ability to pay for it and the willingness to pay for it. And I see this as my best value personally, but I'll share with you that my wife owns a hybrid. So which should you buy? Let's compare these a little bit as far as value proposition. So we'll look at a claim situation in a minute, but if you look at the guaranteed life with rider, its biggest value is that the initial available amount is substantially greater than the hybrids or the long-term care. And the deficiency of a hybrid is the amount you can pull out is less often than a traditional along the way. And you can see those numbers. And although the total pools look closer here for the traditional versus the hybrid, the amounts aren't far off. Don't forget that shared care bucket. So when we compare at age 80, the 475 for Jack, the 475 for Jill, plus the amount for the third bucket of 475 says she'd really have almost $1 million of protection if she needed that whole third bucket as well. And so $1 million of protection versus 416 or the static life with rider, you can see the differential. Now, a lot of people, we'll discuss which option you should buy in a minute and that, but after looking at those, if you happen to be age 60, maybe neither or none of them are of interest or value to you. And so before you say no to all insurance, for those that are a certain net worth where you're, a certain high net worth, I agree, they might not need long-term care coverage, but I do want you to know that high net worth people buy long-term care coverage on a daily basis from us because they understand the leverage effect, they understand the tax-free effect, and some of them gravitate to a product like this. And not, the people that don't necessarily have a lot. Let's say that you're a married couple and you have a $1.5 million net worth. Well, you could spend that down. You might have enough to cover each and both of you, but when you break out how much is in the house and where the other monies are, maybe you run a risk of having problems down the line. And before you say no to insurance altogether, maybe you put a safety net in. So this product is one of the unique joint life options in the market. By joint life, I mean it insures Jack and Jill. This is actually a second to die life insurance policy. And the difference between the life with rider we just shared is this won't pay for the first person who needs care. This is only going to pay for the surviving spouse or if both spouses needed care at the same time. So think about what typically happens. I see a lot of married situations. They retire, husband gets sick, they don't have long-term care coverage on them. Wife becomes the caregiver for the husband until she can't. And once the husband passes away, the wife is left with less assets because they were paying for care perhaps. They might lose some Social Security income in the household. And if there was a pension, the wife might get less than the full pension or none at all if they didn't take a joint survivor option. And so Jill could be in a more precarious situation under circumstances like that. And having this safety net can be a big deal. And so long story short, because they allocated $200,000 over 10 years, they bought a $681,000 death benefit. And if neither Jack nor Jill need care, that money is going to go to their heirs. And if Jack needs care first, in my perfect little world example, this policy won't pay. But if they drain down the assets, we know Jill is left with less, and therefore, if she needs care later, that's the value of this policy. She now has $13,000 a month available until she depletes the whole $681,000, and whatever she doesn't use for care will be passed on to the heirs. So a unique policy out in the marketplace that some people will gravitate to depending on their scenarios. And so here's a graph just giving you some highlights of the different products and the leverage capacity of them. And although I didn't cover the annuity hybrids, there are annuity hybrids in the marketplace, just like there's life insurance hybrids. So the least amount of protection, of course, is self-funding. You're on your own, and hopefully your assets will be enough. Hopefully you don't need care at all, right? But annuities offer leverage, but not as good as the life or the hybrids we looked at. This is life insurance with a rider, the middle one here. The life, the combos, the hybrids are here. And as we discovered, so life with rider doesn't offer as much protection as a hybrid, and hybrids don't offer as much protection for traditional, all things equal on the premiums as we went through. So there's two important questions. If you have long-term care insurance, and you need care someday, there's going to be two important questions that you ask. How much will you give me? And how long are you going to give it to me for? And that's the claims game, if you will, that you need to pay. Now, understand what I'm saying is, I don't know which one's best for you today. and you don't know which one's best for you today. Tomorrow you'll figure it out, but you have to play some claims game examples, if you will. And so when we look at our comparative chart again, if we knew that 2 years after purchasing any of these products, Jill was going to die, we'd certainly, it's a no-brainer to say we'd want life insurance with a rider, because Jill would have paid her $20,000 for 2 years of premiums, and then she'd have the $267 coming back to Jack. But if at age 80, she needs care for a couple of years, we might change our mind as to which product she might want. She might still want life with rider, but what if she needed care for 5 or 6 years? So you see, I can't tell you today which one's the perfect one for you to buy, but I can tell you that they all accomplish what we're trying to do, and that is taking a few dollars and leverage them into more dollars that come out income tax free, so that you have a higher chance of not depleting all your assets for care, and you're able to afford quality care and not go down the Medicaid spend down scenario. So only hindsight is 20/20, as they say, right? We'll only know in the future which one we should have considered today, but they all help alleviate some of the risk that we hold. As I mentioned earlier, it takes not only money, but good health. And this is something that a lot of people don't consider enough. They just they push it down the road, kick the can down the road, as they say. And if a health event happens, and I can tell you firsthand stories in my family where that has been the case, that the opportunity might pass you by. Now, some people have events and recover as well, and so that can happen too. But you're leveraging for tax-free dollars. And as I mentioned earlier, if you have legacy goals, we want you to be aware that you might want to do those, especially if you're not using any long-term care. So the question for you is, should you remain self-insured? And that's a conversation for you, your spouse, your family, your financial planner, and we're happy to add our 2 cents. So today, hopefully we've given you some insight to consider how long-term care itself is a family or lifestyle concern. If you don't have means and you corner your kids to have to be your caregivers, how does that work for them? Have a long-term care conversation with your family, with your planner. Think about how your portfolio could be impacted if you had an event. Evaluate whether or not an insurance product makes sense for you. Call your advisor who invited you on the call to review your plan with you. And if you have specific insurance things, you can certainly reach out to me. Now, if you would, please do copy down this link. Our website is for advisors, but we redesigned it, and we're have an educational portal for clients. You can only get to it if you type in the ending here of it's my email address with /client-resources, and you'll get to a number of resources for all 4 product lines that I work in. But most importantly, I want to mention and encourage you to look at the insurance insights that I have there. Taking the first step is a piece that regurgitates some of the statistics we've looked at. And it gives you a whole list of different questions, and it walks through the pro and con of those 4 different angles of, are you relying on your assets, the government, your family, or does insurance make sense? There's a short video in there, about 10 minutes, that looks at what we already did with the core insurance comparisons. And as I mentioned, we're recording this. We're going to put a copy of a recording of this up on the website within the next week or so, so you can go there and re-look at this or share it with your spouse if they weren't able to join today, or others that might get value. And so the Exploring the Options video is the shorter one, just looking at the insurance flavors. And this presentation will be up on there after the recording. So I'm going to get to Q&A in a minute here. And so if you do have some questions that you want to ask about anything we went through today, please add them in there and I'll answer those questions in a minute. But I want to heighten your awareness to what's going on with certain governmental situations. And so you see the Washington Cares Fund last year, the state of Washington invoked a 0.58% payroll tax for all W-2 employees. And that whopping 0.58% of W-2 taxation provides you a lifetime benefit of $36,000. So a very insignificant benefit. And not only that, they restricted the benefit to qualifying with 3 of the 10 activities of daily living. Now, I want to be forthright with you. I don't even know what 10 activities of daily living are. All of the products we looked at trigger when you are unable to do 2 of the 6 activities of daily living. That's bathing, dressing, transferring, eating, continence, and toileting, or just cognitive as a 7th or solo thing. So if you're cognitively disabled, that alone will make you qualify for benefits from all of the different plans we looked at today. And so who's next? Well, we know that New York is looking to implement this as early as next year, and they've done some tricky stuff, making you have to have your coverage enforced before the end of the year in order to be exempt. You see, that's what Washington did. They overwhelmed the insurance industry in capacity, and a lot of people from Washington ran out to buy a qualifying long-term care policy, and that allows them to be exempt from that 0.58% payroll tax. New York's doing something trickier. They wrote the law that once we make the law official, it goes back to January 1 of the year we did it, and you would have had to have coverage in force before then. And so right now, a lot of people think this is going to happen next year for New York, and if it does, you've got 2 months left to get your coverage in force if you don't have it to become exempt from whatever they tax you at. And so note the other, the top line of Pennsylvania, California, and Minnesota. These are more active, likely to happen first potential state situations. And you see the rest of them, including my state of Illinois, that are kicking the tires on this concept. Again, just another way to tax us here. And, the shame of it all is they're giving people a false sense of security that they have something, really good. In Washington, you have a whopping $36,000 total benefit. So I think it's kind of sick how they're doing this and what they're doing. And it causes people not want to talk to me, the insurance guy, and under false pretenses of thinking you're all covered. And then you find out that, you have very little coverage at all. And if the more you make, the more this is going to hurt, right? If they take 0.58% of your payroll and you make a good income. So just be aware of this. And if you're in one of those states, it applies. And here's a picture of my mug for you and my contact information if you want to write it down. And I'm going to turn my attention to any questions that we've had through the presentation here. But let me stop my recording. All righty. So first answer from somebody is,